So today's topic is, how do you finance an ADU where you have very little equity, or in some cases, no equity at all? Yes, you heard it correctly. So let's say you buy a house, right? And let's say you pay $1 million for the property, and let's say you owe $950 for the home, but you want to add an ADU to the property. Most lenders will not allow you to tap into the home's equity because your loan to value ratio is so small. Mike Yates with My Home Lending actually has a program where they will finance up to 120, or is it 125% of the after repair value, or 95% of after repair value?
It's the lesser of the two. So up to 125% of the purchase price, or 95% of after renovation value based on the appraisal that we'll get from the appraiser.
So basically, let's say you purchase a home for $1 million, you can get up to 125 potential percent above the purchase price. So meaning you can get potentially up to $1,250,000 or 95% of the ARV. It's a great program. Mike will further explain it to you. So Mike, tell us about the program.
Yeah, so you would, say you find the house, it's your dream house. It has the land for the pool or for the ADU, but you don't have a lot of cash for the improvements after you close. So you'll do your traditional financing on the first. If you want to use me for that, fantastic. But so say you put down 5 or 10% on your $1 million purchase, and you really want to build that ADU for your mother-in-law or someone like that and do the pool. So this program will allow you to go to the 125% of the purchase price, or 95% of the after renovation value, whichever is the less of the two. And it's a true renovation HELOC, though. So you're going to close like you normally would. And then after you close, that's when you want to start working on getting your plans and permits done ASAP. So once you get your plans and permits completed, we'll apply for the loan and make sure you qualify based on what the potential loan's going to be. And we give those plans and permits to the appraiser. The appraiser is going to appraise the house based on the current situation and also with your improvements. So say you're going to do some renovations to the house. So you're going to remodel the kitchen as well, new flooring throughout. So you can, there's no limitations on what you can do with this program. But it's a true renovation HELOC where they're not going to let you pay off credit cards and your car payment along with it. It's true renovation. So based on those plans and specs, the appraiser is going to come back with the potential future value. Everything is completed. So when we submit the loan for approval, we're going to have that along with your credit package, income documentation, and based on what it comes back at, we can go up to, like I said, the lesser of those two. And in most cases, it allows you to do everything you want to the house.
Yeah, which is amazing. So like the way that works for our viewers is the appraiser will take what you're looking to do to the property and then finance what the house is worth after the repair or after the repairs are done. So like, let's say I have my house, and once I add the pool, or once I add the ADU, the house value is going to go up. That's one of the formulas that they take into consideration for the qualification of the program, basically.
Correct.
Yeah, that's amazing. And oftentimes that could be above the price that you paid for it, basically, if I'm understanding.
Oh, yeah, in most cases, yeah.
Okay. So you said the program is based on a HELOC, right? Tell us how that works.
Yeah, so it's your traditional HELOC. It's a 30-year loan. The first 10 years is your interest-only draw period. And so the beauty of it is that with the renovation here, you don't start paying on the loan until you actually have a balance on the loan. So say your loan is for $250,000, but it takes time. You have to get your foundations poured, or pay things to the contractor for the deposits. So say you close and you need $15,000 for the first few months. You're only paying on $15,000. You pay on it as you go. So that's the beauty of it, is that you're not paying $3,000 or $2,000 a month on it right away. It gives you the flexibility to kind of pay as you go.
I think the key thing is that they're doing the value on the after repair value, and they're using that as a potential formula, which means that you can go higher than whatever you purchased it at, even if you have very little equity to no money down, basically.
Right.
That's the key. As long as the after repair value is worth more with the ADU and a pool, which oftentimes with an ADU and a pool, it does add significant value to the property. In terms of interest rates, how does that work?
Yeah, the rates are like your normal traditional HELOC. So almost all HELOCs are tied to prime. Prime's currently 7.5%. That should be going down here over the next few months and trending forward. No guarantee, but that's just kind of what the market's predicting. And there's always a margin on top of the prime rate. So if you go the full 95% after renovation value or the 125%, it could be around prime plus 3%, give or take. So call it 10.5% interest only on that payment. If you don't need to go to the full 95%, you can go to 90%, and it's closer to prime plus like 1.25, so 8.5 combined. So that's more traditional HELOC rates right there on the 90%. But if you need to max it out, it's there. It's an option for you. And these are 30-year loans, interest only draw period for the first 10 years. After 10 years, whatever your balance is, you have to start paying that back, principal and interest, amortized over 20 years.
How does a draw work? Meaning, like, is it monitored? Meaning, like, with certain loans, when they're giving you loans to do renovations, they're like, okay, once you reach this milestone, you can get X amount of dollars. Once you reach that milestone, then you can draw. Or basically, what keeps somebody from just giving you guys approved plans and then drawing the full 250,000 and then not do any renovations or not complete any work on the property?
Yeah, there is a master servicer of this who kind of keeps track of these draws and the plans, and they're kind of making sure that things are kept in line, that they're you're not just going to Vegas with the cash and you're actually putting the pool in. You know what I mean? So there are some checks and balances in place to protect the investor and also the homeowner from not using the funds how they shouldn't be.
Got it. Okay. And basically, if I'm understanding it correctly, if you're going to be building an ADU, you have to have the approved plans in order to qualify for the program.
Yeah, well, they're going to do some vetting of the contractor you have. So we need to have plans, permits from the contractor. The investor's going to take a look at the contractor. They'll look at them online. They have their background checks. They do. They want to make sure they're not signing off this $250,000 to a first time builder. For the most part, they want to make sure that they're legit
and make sure that nobody's going to run off with the money, basically.
Right.
Okay. And then if I'm understanding it correctly, you can use it for either renovations for the property, like a pool, the house, or including ADUs as well, too.
Correct.
Fantastic. Good. Anything else that we should know about the program?
No, the beauty of it is that you can get that traditional first mortgage at the market rate. A lot of times with these rehab programs, you have to kind of take a loan that's 1 or 2% above the market. This gives you the opportunity to get that market rate, low rate, and then this can kind of come in behind it. And then once that's done, you can actually focus on paying that down as well. So once you've drawn the loan up to $200,000, if you want to start paying that down, your payment will adjust based on what your balance is as well. So it's pretty flexible, and it's a pretty good tool to have here.
I also think that the good news is that, like, let's say you buy a house, right? And you're looking for a way to bring down your payment. As an owner user, you can add a junior ADU and an ADU. So, like, let's say that it cost you maybe like $250,000 to do that. And let's say that costs you $2,000 a month. A lot of times, because that's interest only, the rents that you can collect on the ADU and the junior ADU are going to exceed that $2,000 a month, basically. So, like, let's say the ADU rents out for $2,500 and the ADU rents out for $1,500. You're collecting a total of $4,000 a month while your payment's only $2,000 a month. So that actually helps offset the mortgage payment, not only on your first, or you can even pay down the second with that extra capital that you're receiving. So I think that if somebody is looking for a way to bring down the rate, has very little equity, I think that this is a great program for somebody to look into. So if somebody wanted to get in touch with you, Mike, how would they do that?
Best way to do it is just on my cell phone. You can text or call anytime. Cell phone number is 805-407-5777. You can look me up online, but always available and happy to answer any questions.
Awesome. So to our viewers, thank you so much for taking the time to watch this. We had Mike Yates. We talked about how do you finance an ADU with little to no equity whatsoever. We talked about a HELOC program that has an ARV component, meaning after repair value or after the ADU is built, to help you get a loan to be able to build that ADU or to renovate or to build that pool that you want to build. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful, make sure to hit that share button. Thank you again, Mike, and to our viewers, until next time.